Now price is there already, and the thing you're giving the shopkeeper is a fiat currency, usually, let's say US dollars. When you're buying a currency though, you have to give them a different currency. It's exactly like swapping your money at a money exchange when you're on holiday. So we are exchanging two currencies, and this is how you will see them right here. So we've got BTC/USDT. What does that mean? Well, each crypto has a ticker. So BTC is Bitcoin, and then /USDT. USDT is called US dollar tether. It's a very popular cryptocurrency and a very useful crypto. I'll get into what a stable coin is and US dollar tether in a second. This is how we read a currency pair. You have BTC against US dollar tether. ETH is Ethereum, so Ethereum against US dollar tether. So you know this trading pair is Ethereum and US dollar tether. And then you have other currency pairs like Bitcoin, Ethereum. So if you just want to trade them directly, you can trade Bitcoin and Ethereum. This is how it will look. We need to get into stable coins though, because these are the entry into the crypto space, and they're also used to trade against every other crypto. So a stable coin is a crypto version of a fiat currency. It is always a crypto version of a real asset. So it doesn't have to be a fiat currency. There are other stable coins that are backed by other very stable real assets, maybe like gold, but it is definitely backed by a real world asset. And that's why it's called stable coin. Its price is pegged to that real world asset. So let's take US dollar tether, which is right here. Also US dollar coin, which is this one, and then Binance US dollar. All three of these are pegged to the US dollar, meaning their value is the exact same value of the US dollar. They do this through various different mechanisms, but you know that if you are holding Binance US dollar, USDT or USDC right here, that will be worth $1 US from now going forward. So it's a really important asset for a lot of people. If you want to come out of a cryptocurrency, you think it's too risky, you can come actually into a very solid real world asset without having to take your money out, and you just put that in the stable coin. So now we know that we trade currency pairs, we can look at the base versus the quote currency. So this is really important to know when you are trading. Here is how it will look. The base currency is the main currency that you're buying. So if you want to go ahead and trade Bitcoin, you can see down here that Bitcoin will be on the left-hand side. That's the base currency. The quote currency is the currency that you're selling or using to buy the base currency. So the base currency you are using, in this case, we can see BTC, it's definitely Bitcoin. And the quote currency tells us how much we need to buy 1 unit of the base currency. And I'll show you the quote right here. So we've got Bitcoin, that's BTC. So we know that that is the currency that we're trading. We can look at the quote currency, which is US dollar tether. So that is the quote. We then have 50,000. What does that mean? It tells us that it takes 50,000 USDT, which is the quote currency, to buy 1 BTC, which is the base currency. This will obviously change depending on the exchange rate between the two currencies. Once more, we have BTC against US dollar tether, now at 55,000. So it now takes more US dollar tether to buy 1 Bitcoin. This can also be shown to you in a percentage move on a day. You'll see this a lot of times. Let's go back to CoinGecko right here, and we can come up, go back to the homepage. You can see this right here. You'll get a percentage change on the day, and this is a percentage change against US dollar tether. So we'll go back to our quotes, and we can see that Bitcoin has appreciated against the US dollar by 5% today. This percentage move will always be how the base currency is valued. So it takes more US dollar tether now to buy Bitcoin because Bitcoin has appreciated 5% against the quote currency. Also really important to know when you're trading is that not every currency pair is supported. So let's say you have a really small altcoin that's like a micro cap. It's not going to be traded against Bitcoin directly. So I've got an example here of Mana, which is Decentraland. It is an altcoin against Cardano, which is another altcoin. It doesn't have a market, at least on Binance. So if you want to sell one for the other, you just can't do it. You're going to have to first trade Mana into US dollar tether and then trade ADA against US dollar tether. So you have to use a third currency to actually trade that. This is sometimes known as a cross trade, where you use a third large currency to trade two smaller currencies that don't have a direct exchange. This is why stablecoins and US dollar tether in particular are so important. They really do help liquidity in cryptocurrencies. All of the big cryptocurrencies though do have direct trading pairs, and this is how you can trade one currency against another. So I have an example here. Let's say you took $1,000 and you invested $500 each, 500 in Bitcoin and 500 in Ethereum. They're the top two cryptos and they both go up in value. Both have gone up, so we're super happy. But you can see here, Bitcoin actually went up 20%. So our $500 times 1.2 is $600. Ethereum though, only went up 10%. So $500, this fort is supposed to be $1. $500 times 1.1 is $550. Now, if you would have just put all of that money in Bitcoin, you would have made $1,200 because you would have gone up 20%. $1,000 in Bitcoin and Ethereum, you only made $150. So actually you would have been better to just put all of your money in Bitcoin and none of it in Ethereum. Bitcoin went up more than Ethereum. And so you can see investing becomes pretty complex, and we're not going to go into diversification here and the benefits that that gives you. They might go up and down at different times and they might have different investors. And so diversification is very key in my opinion, but just to show you how actually trading in one or a different cryptocurrency can definitely change your investment outlook. This is what we call currency pair trading. Which one of these cryptos do you think will outperform the other crypto? You can actually bet on one crypto versus another. This is not just an investment in one coin, but you can think, well, which one of Bitcoin or Ethereum over the next 6 months is going to outperform? Then you want to put all your money in that coin. If you've done research and you think Ethereum is going to outperform Bitcoin over the next 6 months, then what's the point of being in Bitcoin? Put all of your money in Ethereum and it will outperform. You will get a higher rate of return. When you buy cryptos with fiat currencies, so if you've got US dollar or pound sterling and you're just putting money in, then you are actually betting against those currencies, pound sterling and US dollar. If you're selling those to buy cryptos, you're betting against fiat currencies and you're placing your bets into cryptocurrencies. That's what you're doing. Whenever you sell a crypto to buy one other, then you're actually betting against the one you're selling. This is the most basic strategy when it comes to currency investing and with cryptos. The currency you're selling, you're betting against, and the currency you're buying, you are thinking that that one will at least outperform the one that you're selling. So let's just recap on Unit 2 then. Currencies only trade in pairs. You need to sell one to buy another. Stable coins are absolutely vital for the cryptocurrency industry and for trading. We can analyze the quote and base currency to tell us more about how that currency pair in particular is trading, and you can bet on one currency versus another. Unit 3 is the best crypto trading platforms. Really important that you know the difference between them, the pros and cons of each. If you are getting value out the video, make sure you are subscribed if you aren't already. Also, everything in this video is listed in the description for you. So everything you need will be in there. Definitely check it out. What are the best trading platforms? What are the best trading apps? What do they offer us? And what are the fees of each? Let's start with eToro. I've used eToro before. Now, eToro offers many different things, not just crypto trading. You can trade stocks, you can trade CFDs, you can trade commodities, and they have something that eToro called copy trading, which is where you can essentially invest in someone else and you can copy their trades. That might be something that you want. It is definitely the best all-in-one solution in my opinion. You don't have any trading fees here, but they take some money out of the spread. I'll explain what the spread is later on in the video, but you should be paying maybe 0.25 or 0.3%, something like that. Depending on how big the spread is, you can even be paying as low as 0.1. So I think overall their fees are competitive. You won't be paying any fees on top. They'll take those out when you trade. And you can do staking on eToro. eToro also has eToro X and eToro Wallet. They are specific crypto trading platforms and they are very good in my opinion. You do need KYC though, so you're gonna have to give them your ID documents to go and trade with eToro. Overall though, a very good system. We also have Kraken, which is a dedicated crypto exchange. You have Kraken and Kraken Pro. In my opinion, Kraken Pro is really great for pros. A lot of information there, pretty much everything I would want when trading. You get some good staking products, not support for every crypto when staking, but the ones they do support have very good rates of return. They have very decent coin support overall. If you're in America, you might want to check this one out. The fees are very low, 0.26% or below, depending how much you trade. You do need to give them your ID documents. Coming on to crypto.com, this one is a little bit different. They focus more on their smartphone application, which I think is very good. They want you to use crypto to buy and sell things. So they actually give credit cards as well. If you have a lot of cryptocurrency, you'll get super good rates on credit cards, cash back on purchases. So it actually lets you try and spend your cryptos in the real world, which is definitely something the other exchanges don't do. It is very CRO focused. CRO is crypto.com's cryptocurrency. You need to hold a lot of that on account and you get huge discounts off your fees and you get a lot of bonuses as well. Definitely good for some people, this one. We also have Coinbase, which is a dedicated crypto exchange. They'll be making their product offering bigger as time goes on though. You have Coinbase, which is the easy option on your phone. And then you have Coinbase Pro as well, which is slightly more advanced. However, saying that, this is for beginners only. You have very poor support when it comes to staking. You also have very poor coin support overall. And the fees are astronomical. You'll be paying 2 to 3% on Coinbase, and on Coinbase Pro, 0.5%, which isn't that great. Coinbase for me is for first timers. If you want to buy Bitcoin and Ethereum with a fiat currency, then just use Coinbase. But if you want to do anything more than that, I would suggest other platforms. We also have KuCoin, which is one that I really like as a platform. It's a dedicated crypto exchange. It is an alt exchange. So if you can't find an altcoin on another exchange, you might want to look at KuCoin. The thing with KuCoin, it's not that beginner friendly. It's not great at actually using fiat currencies like US dollar to go ahead and buy a cryptocurrency, and you can't withdraw fiat currencies from the system into your bank. It's just not something they support. This is a crypto exchange, and so it has extremely low fees, but you do need to be an intermediate to advanced user and have other exchanges as well that you can actually transfer the cryptos back to if you want to take some money off the table. There's no KYC on KuCoin. You can set up an account and start trading with cryptos. You don't need KYC. Huge benefit of this exchange. And if you are a US citizen and you're banned from other exchanges, you might want to have a look at KuCoin. Binance, though, is really the king of crypto exchanges. I would recommend every crypto trader to have Binance. They're just simply the biggest and baddest crypto exchange. They have a vast amount of products. You have trading, you have a decentralized exchange, you have derivatives on here as well. Pretty much everything that you could ever want, Binance has. It has amazing staking support as well for coins. It has amazing coin support. It has the lowest fees I've seen at 0.075. It has the highest liquidity as well. That's for Binance. Binance US is a little bit different. The product offering is different and you don't have as many coins. If you're in the US, you're just gonna have to deal with that. But Binance is the number one pick for me. I would suggest that you go with Binance, at least having that as an account with some others as well. Here are my thoughts on exchanges so you can go and have a look at them. All of these exchanges are listed in the description. You can go and have a look and see which one is best for you. I think all of these are great for different people. So let's recap Unit 3. Just pick the best platform for you. If you want to actually trade cryptos, don't use Coinbase. It's just not that great for that. Later on in the video, I'm going to get really specific with technical analysis and how to input trades. Coinbase isn't going to help you with that. I would suggest Binance, KuCoin, or Kraken if you want the pro tools. Unit 4 is centralized versus decentralized exchanges, and you may have heard of both of these. What are the pros and cons of both? Should you use a decentralized exchange? What are the benefits of DEXs? What are liquidity pools? And which one should you choose? Let's get into what is a DEX. Well, a DEX is a decentralized exchange, meaning that it's essentially just a bit of code and that's it. When you have a centralized exchange, then that is actually a company that provides exchange services and liquidity. It provides you all the systems for people to go and trade with each other. A decentralized exchange is just a bit of code on a blockchain. It has no central operator and you are on your own 100%. On a decentralized exchange, you don't actually trade with someone else, but you swap tokens. It's a really different type of trading, but you do have very low fees. You can see you can pay around 0.05%. So the fees are very low, and that's because it's literally just a computer program. So I've got two examples here. You can see Uniswap up here, and you can see PancakeSwap here, essentially doing the same thing, but they're on different blockchains. Uniswap is on Ethereum, PancakeSwap is on Binance Smart Chain. Swapping is super different to trading. I'll get onto that in a second, but essentially when you swap, you're just using the blockchain and the decentralized exchange to go into an existing pool of assets and use your currencies to swap for the currencies inside the pool. Very different from a centralized trading exchange where the exchange actually just matches buyer and seller directly and you trade together. What are the biggest DEXs though and the biggest blockchains for DEXs? Well, you have Ethereum, which is a smart contracts blockchain. You need a smart contracts blockchain for a decentralized exchange and swapping because you need smart contracts in there. So Ethereum has Uniswap, by far the biggest. Binance Smart Chain has PancakeSwap, by far the biggest on Binance Smart Chain. Then you have Solana, Cardano, and Polkadot. They have some DEXs growing on there, a lot smaller than Ethereum-based DEXs though. What are swaps then? You can see right here, this is a swap. You can swap one token for another in a completely decentralized way. The fees are way, way lower, so that's definitely an advantage of a DEX. You have to use a crypto wallet though. This is not a company that is providing you a service. It's simply a computer protocol, and you need a crypto wallet and coins in a wallet to actually go ahead and swap. And the way that you swap is through a liquidity pool. So people put all of their coins in, and then you can swap in and out of that pool. This is PancakeSwap right here. So you can see I'm actually exchanging Binance coin into Cake tokens, and I'm using a liquidity pool to do that. Liquidity pool is a massive collection of tokens. So you have other people, and these are called LPs or liquidity providers, and they provide their tokens or just literally give their tokens into the pool to provide liquidity for other people that want to swap. The reason they do that is because they earn fees. Liquidity providers or LPs earn trading fees, and this is great. So you can actually earn fees yourself. If you have some coins, you can put them in the pool and you can earn some exchange fees, which is really great. Most liquidity pools will use an automated market maker system or an AMM. Back in the day in the stock market makers were actual people who did all that thing with their hands and bought and sold and actually facilitated trade between a buyer and a seller to big organizations. Now that is done on the blockchain by a computer system. The AMM will match a buyer and seller and will get a decent price for them both with the swap. What are the pros and cons of this? Well, DEXs are really decentralized, so no one owns them. Also, they're very low cost. You have massive access to really small altcoins, which you may want to go ahead and trade. They also offer staking and rewards. So like I said, put your coins in a liquidity pool and you'll earn trading fees. That is a way to increase the income that you get from your cryptos. There are also staking rewards as well to increase liquidity, so you get paid for that. You earn commission instead of paying it. Obviously, you pay it when you trade. There are security concerns for DEXs though. A lot of security concerns, especially smaller DEXs. There have been a lot of rug pulls, millions of dollars stolen, so that's definitely a downside of a DEX. You might just want to stick to the top 1 or 2 DEXs, and they are way too slow for day trading. We cannot use a DEX for day trading. We get no charts, we get no order book, we get no technical analysis, and they require a cryptocurrency wallet to go ahead and use them. Here is the pros and cons of a DEX versus a centralized exchange. You can read these, but essentially a DEX is very, very low cost. You get access to small coins. You get yield farming, so you can actually earn more. You can earn commission by putting your coins in, but it is very blockchain and very crypto. A centralized exchange is just like trading on the stock market or anything else. You have an actual company who is there providing you a product. You get ultra fast trading. You get all the pro trading tools. You get great charts. You get a lot of liquidity, which is super important when you're trading a lot of money. There are some downsides, but centralized exchanges are an absolute must if you are a trader. So what's the recap? DEXs offer swaps and yield farming. That's a positive. They only run on smart contract blockchains. They have pros and cons in terms of they're slow and they're also not great for day trading. And they also have security concerns if you go for the less well-known DEXs. We're going to have to use a centralized exchange to day trade and swing trade our cryptocurrencies. Unit 5, and we're getting into the good stuff. If you haven't done already, check the description for everything I'm mentioning in this video. Do like the video and subscribe if you haven't done already. Crypto trading strategies. This is what you want to know. So what are trading strategies? What are the best trading strategies? What type of investor are you? Are you short, medium, or long term, or are you a mix of these? And what is dollar cost averaging? Super important to know. Now this links with Unit 8. Everything I'm going to talk about from now on is really a build up to the end of the video where we're going to be trading. We're going to be going through trades, but you have to know everything first to build up to what we're actually going to do. You need to know the basics, so we're going to get into it right now. First, I'm going to come on to swing trading. Super popular. A lot of people do this with stocks, Forex, and cryptocurrencies. Swing trading is short and medium term only. This isn't a long-term strategy. You open trades for maybe a couple of days, maybe a couple of weeks, but with swing trading, you're looking maybe a few days, maybe a couple of weeks, depending on the trade. You use both technical and fundamental analysis for your trading, but we certainly rely on technical analysis for when we're getting in and out of our trades. And what you want to do with swing trading is just capture a percentage of a price move. So you want to anticipate a move in the price, either up or down, and then place your trade so that you get at least a percentage of that and make your money. One of the benefits of swing trading is that it requires less time. You don't need to be researching. You can use some technical analysis here to just get right in and start trading. You can definitely make some short-term profits. And with swing trading, what I'd be using is the 1 day chart. If that doesn't make sense, it will do later on in the video. We're going to be using a 1 day chart for swing trading. Downsides of swing trading, could miss out on the longer term trends. You know, if you just invested in Bitcoin 5 years ago, you'd be up a lot now and you wouldn't have had to have done anything with swing trading. So that's definitely a downside of swing trading. And with swing trading, you can be stopped out a lot with short-term movement. So you actually may be right about a trade, but in the short term, the price could just move up in the wrong direction, stop you out of a trade, so you make a loss, but you were right about the trade. So that's just part of trading, one of the downsides of swing trading. Thanks to Investopedia for this image, though. I'm going to use this to describe what swing trading is. Now we can see, we can use a chart, we can use some analysis, and some chart patterns to go ahead and swing trade. If you think this looks crazy, I'm going to explain exactly how to do it later on in the video. We can see a small cup and handle pattern right here, and we also have a consolidation period right here. These things are what swing traders use to trade. You can get into a trade around here, you can ride that, that is a swing, and then you can put some stop losses in place and basically get out. So a swing in the market, you've taken a percentage of that move and then got out of your trade and made your money. I'm going to be showing you swing trading and also breakout trading later on in the video. What is breakout trading? Breakout trading is slightly shorter term than swing trading, but it can be for the same amount of time. It really depends on you as a trader. You open trades for maybe even a few hours to a couple of days, and you mainly use technical analysis, but you need also to know what's going on in the markets and what types of news may move the markets as well. We can use specific chart setups for this, and I'm going to show you exactly how I trade and how you would go ahead and do a breakout trade later on in the video. We want to capture a breakout in the price. Now, what is a breakout? Well, there are specific things we look for that show us whether there is going to be a breakout or not, and that's how you trade. It requires way less time because you're really just looking at potential breakouts and you're putting your trades in. Definitely short-term profits with this one. We can use either the 1 day chart or maybe the 8 hour or 4 hour chart, depending on who you are as a trader. You could miss out on longer term profits once more. And again, short-term swings can stop you out of your trades, making a losing trade, but it may actually go in that direction. That happens quite a lot with breakout trading, so something to be aware of. Thanks again to Investopedia for this one, but this is essentially a breakout. So what happens is trade in an asset, let's call it Bitcoin, will actually go and consolidate like this. And we use these lines, and I'll talk about that later. This is actually what we call a wedge pattern, and it is possibly going to have a breakout from that pattern eventually. So this is what breakout trading is, trying to spot areas of consolidation that could then lead into a breakout. Place your trade, get that move and the volatility in the price, and maybe take advantage of it. We can see right here, this is the area of consolidation that we want to look for. Breakout traders will look for this to place their trades and essentially try and make some money when the price breaks out of that bracket. Another strategy is called scalping. Ultra short term, I'm talking intraday trades. You'll maybe looking at a 5-minute chart, trading 10, 20, 30 times a day even. There are computer systems that scalp as well. You may open trades for a few minutes to a few hours, certainly not overnight and not a few days. Only rely on technical analysis and nothing else. You trade off tiny movements in the price. Now this requires a lot of time, a lot of effort. You have to be watching the screen at all times. But you get hundreds of trading opportunities per day, definitely. So if you want to trade a lot, look at scalping. There are a lot of opportunities to trade with scalping that long-term investing just doesn't give you. Essentially what you're doing with scalping is actually trying to trade off other people's orders. If a huge buyer comes into the market over a very short period of time, the price may move up a tiny amount, let's say 0.25%. In Forex, it's going to be much smaller, but in cryptocurrencies, it might be 0.25%, maybe 0.1%. As a scalper, you're trying to anticipate that, get in off the back of their order and try and basically buy some crypto before they finish their buy and then sell it to them as well. It definitely requires more funds. It's very difficult and time consuming to implement, but this is what a scalping setup would look like. I have a 5-day, an 8-day, and a 13-day moving average on here, and you can see all of these swings. So we have one swing right here. Now remember, this is intraday. This is a 15-minute chart. So every candlestick right here is 15 minutes. If you don't know what candlesticks are, if you don't know what this chart is, don't worry. All of this is going to be explained as we go through the video. You can see though, this is an area where we could trade. We could try and ride this up and then sell up here. We can also ride this movement as well. Now these lines here are a very simple way to try and anticipate movements in the price. We also have a movement of the price here, and we also have a movement of the price here. These are ultra short-term intraday price movements that a trader can take advantage of, and you can just make your profits like this. Now, one of the downsides is that it can move against you very quickly, but that is scalping. Then we come on to a completely different strategy called dollar cost averaging. This is not a day trading strategy. It's not a short-term strategy. It's a long-term investment strategy. Now, you are purely price agnostic. This means you don't care what the price is. You don't care how the price is moving short-term. You just put in money at regular intervals. You really trade off fundamental analysis, essentially meaning go and research a project, go and look at the tokenomics, go and look at the fundamentals. Is it a good project? Does it have good people? Does it have a good future? Yes, it does. I want to invest in that project over the long term. This is investment, not trading, and you don't have to deal with FOMO or fear of missing out because you're in for the long term. It actually requires little time. Really what you have to do is research a cryptocurrency or other cryptocurrencies that you want to invest in. Once you've done that, all you have to do is just go and set up your dollar cost averaging setup, and it's really simple. You don't have to trade the markets. Not interested in the short term whatsoever, and it relies on the premise that markets go up over time. Low cost, low, that should be a W, low cost, low stress. One of the big benefits of dollar cost averaging is the mentality of it. You don't have to worry about missing out. You don't have to worry about buying in dips. You're just going to drip feed investments over the long term. Mathematically speaking, there is no mathematical advantage to dollar cost averaging compared to lump sum investing. However, that's not really the whole story. So I'm going to show you some differences here. And of course, if you dollar cost average and you build up large positions in cryptocurrencies, you could face significant losses. If you go heavy into a crypto over the long term and you're not keeping up with the crypto and the fundamental analysis, that price could drop a lot and then you're in a loss. Because you're not trading daily, you can't really save that loss because you're not looking at the markets as a daily trader. But here is what dollar cost averaging would look like. All you do is choose how much you want to invest, and then you split that up over a time scale. So I've just done it once a month here. So let's say you've got $2,500 to invest in Bitcoin. So you start in May. Now, rather than putting $2,500 in, you put $500 in. The price of Bitcoin in May is $49,000. So you've got $500 worth of Bitcoin, and each Bitcoin was worth $49,000. Now in June, you add another 500, July, August, September, you add 500 each month. We can see the price of Bitcoin each month changes. 49 here, a little bit more expensive, then a bit cheaper, and then a little bit more expensive. What's great about dollar cost averaging is that you can not worry about getting in at the wrong time. You can just buy some at cheaper prices, buy some at more expensive prices, but it doesn't matter because your average price is decent. This is how DCA or dollar cost averaging compares to lump sum though. Let's say I dollar cost averaged into Bitcoin over 5 months. My investment overall, $2,500 would buy me 0.05 of a Bitcoin. Now in September, that would be worth $2,513. I've definitely made some profit here because the Bitcoin price has gone up for me and I bought some cheaper. I bought some at 49, I bought some at 49.8. It's all under this, so I'm up on my trade. If you would have just gone ahead though and invested in May, lump sum $2,500 in May, then you would have actually got a much better price because the price of Bitcoin has gone up. You would have actually bought 0.051. So you would have got slightly more Bitcoin in May because you were investing more money at the lower price. And so actually the lump sum would have made you more money by September. Lump sum's beaten out DCA in this occasion, but let's say you put $2,500 in July when the price is very high. Well, you put $2,500 in at a really high price, $50,100. And so you just didn't get as many Bitcoin. You actually got 0.049 Bitcoin. And the price now in September, you're only making $4 profit on that trade. So this can basically show you the difference with dollar cost averaging versus lump sum. If you get in early and at a low price, lump sum is better. But if you haven't, dollar cost average is great. And if you don't have a lump sum to invest right now, if you're a young guy who just wants to build up and accumulate, then dollar cost averaging for an investment really is the only way to go. So let's recap trading strategies. You can trade short-term and you trade off short-term price movements. It requires skill and knowledge. Short-term trading is a full-time job. I did it as a full-time job, so I know it takes a lot of time, a lot of effort, and you have to look at the market all day long. You can be a long-term investor, which is a completely different strategy. You can use DCA, but these are not exclusive of each other. You can dollar cost average and also have some money aside for the short term to take advantage of short-term opportunities. Also, see Unit 8 for this. We're going to be getting into some really specific details of technical analysis. So this very simple and basic overview is going to stand you in good stead for the more complex stuff in Unit 8. So if you haven't done already, make sure to subscribe to the channel. Also check the description for everything I'm talking about in this video. Tons more information and resources in the video description. But let's get on to order types. What is an order book? What is the bid offer? Or if you're American, it's called the bid ask. What is the spread and why is it important? And how do we use market, limit, and stop orders to actually go ahead and trade? We're gonna get into all of that right now. So let's look at the order book. And this is something that beginners will look at and just think, nope, I'm not interested in this. I'm going to use the easy convert feature. I don't want to see this, it's too complex, but let's break it down piece by piece and actually see what's going on here. So this is the order book, or very simply, just the open market in a cryptocurrency pair. This currency pair that the order book comes from is Bitcoin against US dollar Tether. So what we can see here essentially is buyers and sellers, and they're opening their orders to us. We can see their orders, or at least we can see the orders that they want to make public. When it comes to trading, there are a lot of orders that aren't public. When I used to trade, we used to get really big orders and then actually only show some of that order to the market. You don't want to open your hand. You don't want to tell everyone that you've got like $10 billion worth of stock to sell, because obviously the market is going to go down because they know you're a seller. They're not going to pay up. So you only show a small amount of your trade. Now for small retail investors, if you're trading $1,000, $100, $20,000, it's not going to matter. However, knowing what the order book is and looking at orders is super important. So this is really how it works. These are sellers right here. You can see all these red orders right here. These are sellers. These are people and traders in the market that have gone out and told everyone else, hey, I'm a seller and this is my price and this is how much I want to sell. Conversely, on the bottom end in green, these are buyers. These are people that are out there saying, I want to buy Bitcoin and I'm willing to pay this amount for an amount of Bitcoin. That's all an order book is. It's a group of sellers at high prices and buyers at low prices. Why? Well, sellers want to sell for the highest price possible, obviously, and buyers want to buy for the lowest price possible. When sellers and buyers are very far away from each other, you can see they're physically far away from each other right here. They're just not going to trade, and so their order stays on the system and it's not traded. When a buyer and seller meet at a price, then they will trade. Here is the best bid. This means this is the highest bidder. So the person who is willing to pay the most for Bitcoin obviously is the one that buys it before everyone else. And we can see that the best buyer right here is willing to pay $58,548.68 US dollars per Bitcoin. Now, when you're broking or trading, you don't want to keep quoting the whole price all the time because it would be ridiculous. You have people ringing you up all day saying, what's the price? You don't want to say, hey, it's 58,548. So what we do is just take the last four digits and we'll say that the price is 48.68. Okay, so the trader will know, okay, so it's trading at 58.5, 48.68. Now, with cryptocurrencies, it's a little bit different because the big number can change a lot. I mean, it can change 5-10% in a day. So this might go to 59, it might go to 58.6. So it's a little bit more difficult with cryptos. But for this example, I'll say the best bid is 48.68. The next bid down is 48.64. And then the next bid down is 45.85. These other bids have got no chance of trading right now unless the market moves. On the other side, this is the best offer of cryptocurrency, or the lowest seller. He's trading at 48.69. So we have the best bidder, 48.68, and the best seller, 48.69. How do we know what price Bitcoin is right now? Well, it takes the last trade. The last trade you can see in the middle here, 48.69. So actually the last trade was a buyer who paid for this seller's Bitcoin right here at 48.69. That is the last trade on the ticker, 48.69. If you want to know what these are, we've got the price of Bitcoin valued in US dollar Tether right here. You can see price USDT. This is the amount of Bitcoin. So what this is saying on this order book at this price at 48.69, I've got sellers of 1.43 Bitcoin. So 1.43 Bitcoin is on offer, is on sale at 48.69. And you can see the total value in US dollar Tether, $83,757. So So that's it. That is all that information is. It's prices and levels of buyers and sellers. Let's get on to the spread then. The spread is the difference between the best bid and the best offer. We know what the best bid is, it's 48.68. We know what the best offer is, it's 48.69. The spread is the difference between the highest bid and the lowest offer. Spreads are really important when trading. Traders want the lowest spreads possible because once you buy something on the offer, then obviously you're going to be in a loss straight away. If I buy at 48.69 and I sell straight away, I can take 48.68. So I'm actually going to lose that 0.01 straight away. It prevents people from making free money. When you're a trader though, you want a very tight spread. This spread in particular is as tight as it gets, 68 to 69. There's nothing in there. So a very, very tight spread for Bitcoin on this day. Tight spreads are good for traders. We want tight spreads. We want a tight market, liquid market, very tight spreads. It means that we can trade often and not have to worry about the price moving a long way to actually make up the spread. Let's say the spread was a 10% difference. If you bought on the offer, the price would have to move up 10% just for you to break even. So a tight spread is favored by traders overall. Let's get on to a market order then. What is a market order? If you want to buy some Bitcoin, then we can go ahead and place a market order. A market order is when you choose the amount that you trade, the amount of Bitcoin that you want to buy, but you do not choose the price that you pay. You have no say whatsoever in how much you are paying. So where are we going to buy one Bitcoin? If we want to buy a Bitcoin and we're having a market order, so we know we want to buy one Bitcoin, but we can't choose the price that we pay, then what do we have to pay? Where are we going to pay? It's here, of course. These are sellers telling us that they want to sell Bitcoin at 48.69 and they have 1.43 Bitcoin on sale. If we're buying one Bitcoin, we can go to them and buy their Bitcoin at 48.69. Everyone's happy, you've got your Bitcoin, the sellers have told you their price and you've taken it. There's a few downsides to market orders though. Firstly, the pros. You can trade quickly. There's a seller right there telling you, hey, I've got Bitcoin to sell. You want to buy it? Here's the price. You can buy it straight away. It's easy to use. It's the easiest order type. You can very simply put in a market order. But the downside is that you can easily pay too much for your crypto. Maybe you want to buy Bitcoin, but maybe you're going to wait a little bit for a seller to come in because you actually might want to buy it a little bit cheaper. Well, you can't do that with a market order and you're always on the wrong side of the spread. We know what the spread is now. If you're buying with a market order, you're always going to be paying up for other people's offers. And this is obviously higher than these bidders right here. This is the best bid. He's paying a little bit less if sellers come in. But as a buyer, you're paying here. You're paying a little bit more for your Bitcoin. Let's see the order book live then, and let's see how we'd put a market order on. This is the live trading screen for Bitcoin US dollar. We can see the base currency and the quote currency right here. We can see the difference and all the prices and all the movements. We can see the chart right here, and we can see the order book. The order book right now is going crazy. This is how order books look. The market and the prices are changing all of the time. But let's put in a market order. We can come up and we are a buyer of Bitcoin. Remember, that means we have to sell US dollar tether. Let's go to a market order right here and you'll see the price. Cannot choose it. Just says market. Whatever the price is on this order book at the time that we press buy, that is the order we are getting, but we can choose the amount of Bitcoin. Let's buy 0.05 of a Bitcoin. And you can see we can just press buy here. We cannot choose the price. We don't know what we're getting, but we know it's going to be roughly 55,362. Looks to be going around 62.12, 62.13, 62.10 right now. So you can be pretty sure as long as you're not buying too much, you'll get that trade. But what happens, look, it's now at 85. So if you just press this at the wrong time, could actually get kind of a bad trade. So that's the downside of a market order. But very simply, buy, market, amount, press buy, and you're done. Let's come to limit orders then. Choosing the amount we trade and the price that we trade at. Huge advantage here. Remember, where are we going to buy one Bitcoin? We are a buyer now, and we're going to choose the price that we pay. Where are we going to put that order? Right here. We're a buyer. We can put the order in as a bidder, as a buyer at a lower price. So instead of paying other people's prices, we now choose the price that we pay, and we can put it at a lower price than these sellers. What we're essentially saying is, I don't want to pay your price. I'm going to wait for sellers to come in so that I get a better deal for my Bitcoin. What are the pros and cons of limit orders? Well, we can choose our price. We can join the best bidder, Or even we can just come somewhere down here and just say, you know what, I'm going to wait for the market to jump around. I think I can get some cheaper Bitcoin. So I'm going to pay $40.92 instead of $48.68. The thing is though, we can't guarantee that we trade. We don't know if sellers are going to come in. We don't know if we're going to get any Bitcoin. We have to wait for sellers to come in and agree to sell us Bitcoin at our price. So that is a downside. You're not guaranteed to trade. However, with limit orders, you're usually known as something called a maker, and so you may benefit from very slightly lower fees overall, which is definitely a positive. But you can see we're not buying straight away and paying this. We're putting an order in down around this level. Let's come back to the Binance trading page and put in a limit order. So we were a buyer. We're going to go to limit. Now we can put in our price and our amount. Look, we can change the price right here. You can actually click on this right here. Let's just click on this order. You can see it changes up here. So I'll click on a bid that is a little bit below the market, changes, press on another one, changes again. Really good little pro tip there. Or we can choose 55,300. 55,300 is below the current price. You see it's trading at 390 right now. So we're not going to trade immediately, but our order will be placed on this order book and it will actually be way down here away from this order book. But you can see we can choose the price that we pay, we can choose the amount that we buy, and then we know exactly what our order is before it goes through, because the system can just times the amount by the price per Bitcoin that we're trading. Also important to note that 55,300, we always quote in one whole Bitcoin or one whole asset. So it's not 55,300 for half a Bitcoin, it's 55,300 for one Bitcoin, and then you are only trading 0.05, and so you can see it does that calculation for you. Once you press buy, you will not trade straight away. We cannot trade straight away because our price that we want to buy at is lower than sellers are willing to trade at. So what happens, it comes down here. It will go in your open orders. You'll see it, it's there, the system knows it's there. And if the price and sellers come in and are willing to sell at that price, then you will go ahead and trade. Next, we come to stop market orders. With the stop market order, you choose the amount that you trade, but you don't choose the price that you pay or get. For cryptocurrency, the price isn't guaranteed. Remember, the word here, market, is the giveaway. Market means we do not choose the price. But with a stop market order, we can actually choose the price when the order is placed in the market. So it's a slightly different way. Now, some strategies will need this order for maybe their stop losses or maybe to buy on breakouts. So you can see it's good for fast trading and it gives you a slightly different way of trading. So with a stop market order, you're telling the system that if the price gets to a certain level, enter a market order for you to either buy or sell. If the price gets to 57,500, sell my Bitcoin with a market order. You can see the price right now is 58,209. Why would you want to sell at 57,500? Well, look, if the price is going down, which it is here, you can just say, look, the price is going down. I'm losing loads of money. I need to get out of this position and stop losing more money. If the price gets down to a certain level where I'm happy to take that risk, if it actually gets down there, then put a market order in and sell my Bitcoin straight away and stop any further losses. You can see if the price gets down here to 57.5, the system will input for you a market order and just sell out your Bitcoin. Using what we know about market and limit orders, a stop limit order then is an order where you can choose the amount and the price that you trade. Traders will use stop limit orders to add onto a winning trade a specific price level. So a stop limit order can actually be placed in different areas, and it tells the system if the price gets to a certain level, then you want to go ahead and put a limit order in. So again, the same example, let's say the price gets down to 57,500, so we're making a loss. You can say sell my Bitcoin with a limit order, not a market order. Remember, a market order, we're not guaranteed a price. We're going to get the best price in the market at that time. With a limit order, we're guaranteed to trade at 57,500, and if there is no liquidity at that price, we may not get our whole order traded. Let's come on to a stop loss order then, which is just a version of a stop limit order, but it stops your losses. So this is important for day trading to mitigate risk. You'll hear people talking about stop loss orders. It's simply an order that you put in and says, if the price gets to this level, then sell my Bitcoin with a limit order. A stop loss order must be below the current price. That's why it's called a stop loss. You're stopping further losses. So if the price gets to 57,500, sell my Bitcoin with either a limit or a market order. But a stop loss is saying I'm going to stop any further losses, and you can use a limit or a market. Doesn't really matter, but it's the same price level. People just call it a stop loss when they're actually coming out of a trade for a loss. It's important to know though, because when you're mitigating your risk when trading, we'll always use something called a stop loss as a backup to know how much our position at risk is. Conversely, a take profit order is a stop limit order, but that makes you money. So we can trade a position in profit. And this is really important for day trading to automate our trading. Again, when we're putting in orders later on in the video, we're going to be using a stop loss and a take profit. They're both the same order. They're a stop market order. We just call them different things when we're talking about losses and when we're talking about gains. If the price gets to 65,000, sell my Bitcoin with a market or a limit order, and you can see it will come up right here. This is known as a take profit because we're actually getting out of the trade with a profit. To show you how to input stop limit orders or stop market orders, let's come back to Binance. It's just over here. Stop limit, we can come in. Now, stop and limit. Stop is the price that you want to tell the system to trade at. So let's say we want to take some profits at a higher price. The current price of Bitcoin is 55,260. So we're going to say at 59,000, I want to enter an order and my limit price is 59,000. What you're telling the system is when the price of Bitcoin gets to 59, enter a limit order for me, and I'm only willing to sell at 59. So 58,999, not going to sell any Bitcoin. I'm actually a buyer right here, just going to switch over to sell to make it easier for you. So stop limit 59,000 and my limit order is 59,000. When the price gets to 59, put in a limit order for me at 59. Now what you can also do is put your limit in at 58. So what you're saying is when the price gets to 59, basically just dump my Bitcoin